SMX recently made a move that most traders completely missed. The company quietly announced that it had opened a corporate account with the cryptocurrency exchange Kraken. At first glance, this might sound like just another speculative headline, but this decision is far more strategic than it appears. This was not a random experiment with digital assets. It was a board-approved treasury decision designed to align SMX's physical material marking technology with digital reserve assets. This is the type of detail that separates investors who simply watch price charts from those who understand how a microcap company attempts to rewrite its narrative from the inside out. If you look at the general market consensus around SMX, the expectation is straightforward and pessimistic. Most see it as a high-risk, high-reward penny stock that historically punished anyone who held on too long. That view isn't baseless. In 2025 alone, the stock collapsed by nearly 99%, wiping out massive amounts of investor confidence and placing SMX firmly in the avoid category for most retail portfolios. But expectations and reality are not always aligned. Earlier this month, SMX cleared one of its largest structural obstacles by converting more than $20 million in debt into equity. This move fundamentally changes the company's financial posture. Instead of struggling under the weight of near-term liabilities, SMX has effectively cleaned its balance sheet and removed a major overhang that previously threatened continued dilution and instability. In simple terms, they wiped the windshield clean so they could finally see the road ahead. At the same time, the company secured a $111.5 million equity purchase agreement, giving it access to capital to fund operations over the coming years. This creates a sharp contrast between public perception and internal reality. On the surface, SMX still looks like a struggling microcap. Under the hood, however, it now has a capital runway that many companies its size simply do not. This tension between perception and reality is exactly where opportunity or danger exists for individual investors. Recent price action reflects this uncertainty. On January 16th, SMX traded in an extreme range, swinging from a low near 22.60 cents to a high above 26 cents. That kind of movement in a single session signals a market in conflict. Bulls and bears are actively battling over what the company is truly worth. Volume confirms this fight. More than 1.2 million shares traded in a single day, a significant number for a company with a market capitalization hovering around $25 million. When volume spikes like this, it usually means one of two things: institutional positioning or aggressive retail speculation. In SMX's case, it appears to be a combination of both, with activity visible across platforms like Interactive Brokers and Robinhood. Unlike megacap names such as Apple or Nvidia, SMX is not driven by slow-moving fundamentals alone. It is driven by headlines, liquidity events, and capital structure changes. Last Friday's trading volume nearly doubled the 3-month average, often a signal that either a new price floor is forming or a large exit is underway. Given the recent debt conversion, the evidence leans more toward consolidation rather than collapse. For self-directed investors, the temptation is obvious. A stock that has been beaten down this badly invites mean reversion thinking. Traders see that the split-adjusted 52-week high once sat in the thousands and assume that even a partial recovery would be life-changing. But that mindset is dangerous. The smarter approach is to watch institutional behavior. Institutional ownership currently sits near 15.7%, with firms such as Anson Funds Management and Virtue Financial actively moving in and out of positions. This is not a passive long-term holding suitable for automated portfolios or set-and-forget strategies. SMX is a high-velocity, event-driven trading vehicle. Now, let's talk about the business itself, because this is where SMX becomes truly interesting. SMX does not simply sell a product, it sells memory for materials. The company embeds a molecular-level chemical marker directly into raw materials like plastic, rubber, or even precious metals. This marker survives the entire manufacturing process. That means a finished tire, glove, or piece of jewelry can be scanned to reveal exactly where its raw materials originated. In a global economy facing intense scrutiny around sustainability, recycled content, and supply chain transparency, this capability is no longer optional. Governments and regulators are cracking down on greenwashing, and paper-based tracking systems are increasingly viewed as inadequate. SMX offers something fundamentally different: a physical, unalterable chemical signature. This is why the company recently expanded its rubber traceability platform to include latex and rubber gloves. SMX is positioning itself as the Intel Inside of the circular economy. While most investors focus on broad ETFs through platforms like Fidelity or Schwab, very few look at the molecular traceability subsector where real regulatory friction is being resolved. When a company claims its plastic bottle contains 50% recycled material, how does it prove that claim? Today, the answer is usually paperwork. SMX replaces that system with chemistry. Governments in Spain, France, and Singapore are already moving toward these standards, and SMX is betting that global regulation will eventually force widespread adoption. If that happens, traceability becomes a requirement, not a choice. Financially, the $111.5 million equity agreement signed in late 2025 is the pivot point. It allows SMX to access capital strategically rather than dumping shares into the open market. This is a dramatic shift from the chaotic capital raises earlier in 2025 that crushed the stock price. Management has effectively built a financial bridge to get from pilot programs to recurring revenue. That said, risks remain. SMX is still an emerging growth company and a foreign private issuer, meaning reporting can be less frequent and transparency requires extra diligence from investors. In a high-interest rate environment, markets favor profitability over promise, and SMX is still in transition. The Kraken account adds another layer to the story. By holding digital reserve assets, management is attempting to create a valuation buffer not directly tied to the success of its chemical markers. It's an aggressive, startup-style treasury approach rarely seen in industrial companies. From a trading perspective, much of the volatility comes from former debt holders who converted their notes into equity. The removal of that $20 million debt significantly reduces the death spiral dilution fear that haunted SMX throughout 2025. When lenders choose equity over repayment, it often signals confidence that the current valuation undervalues future potential. Looking ahead, SMX's future depends on two main catalysts: scaling its plastics and recycling partnerships and maintaining NASDAQ compliance. The reverse split successfully removed the immediate delisting risk, and with shares now trading in the mid-20s, that fear has faded. The next chapter will be written by revenue, not restructuring. To summarize, the expectation was that SMX was a failing company destined for delisting. The reality is that it has cleaned up its debt, secured significant funding, and is integrating digital asset strategy with physical traceability technology adopted by governments. This is no longer a liquidation story, it is a rebuilding story. The daily price swings are surface-level noise. The real signal lies in the capital structure reset. Whether you're trading through Fidelity, Interactive Brokers, or any self-directed platform, it's clear that SMX's risk profile has changed dramatically over the past 30 days. This is not a safe stock, it is not a dividend play. But for those who understand speculative infrastructure bets, SMX represents a calculated wager on how truth, materials, and data will be tracked in the future.